Hey guys, it's Neil. I just wanted to record a quick video talking about what happened in the markets today. For those of you who have been paying a little bit of attention, the Federal Reserve came out today with their, what is it, 8 times a year meeting, and they said they are cutting rates by 1/4 of a percentage point, or 25 basis points. So those press releases, they come out at 2 o'clock. This is the S&P 500 for today. And you can see it was bouncing around a little bit. And then 2 o'clock comes and poof. So, the way it works, if you haven't ever actually watched it, is they publish a pre-written press release, and then all the bots read it automatically, within microseconds, and they start trading it. And then the talking heads come on, and they talk about whatever it says, and then there's a Q&A section and remarks and all that kind of stuff. So this was the report, and then this was the talking. Ooh, all the way down to 2960 on the S&P, and then it recovered some, and market close, and it's been trading all around. So the big question is why. Everybody wants to know why. If rates are lower, isn't that good? Doesn't that help the markets? And it's one of those 6 of one, half a dozen of the other. Yes from one side and no from another side kind of thing. So on the macro scale, it's a very bad sign, because if we look over here, so this is the St. Louis Fed that maintains the Fred database, which has all these charts that you'll see a lot in financial media. This is the effective federal funds rate going back to 1954. And so here's the thing about these things. These shaded areas right here and here and here and here and here and here and here, those are all recessions. That's when things are going down. But if you look at the pattern closely, you can see that, like on this one, rates were going up, going up, going up, going up. This was during the I believe that was the end of the Greenspan era, or maybe that was this one. But yeah, like every time they met, the rates were going up by a quarter point, and they plateaued, and then they turned around, and right after the turnaround, recession started. And that's the official recession as measured by the I think it's NBLS, National Bureau of Labor Statistics, that actually determines the official recession. And then if we go back to the dot-com thing, rates were going up, they turned around, and then recession started. If we go back to the savings and loan crisis and all that kind of stuff, long-term capital management, it's a little bit of a different story. The rate cuts started well before, about a year before the official recession started. And if we go back to the early 80s, this was stagflation. Reagan comes in, Paul Volcker slams up the interest rates. But then right before this recession, rates were starting to get cut. And same thing here, back in the 70s, early 70s, and same thing. This one, the timing is a little bit off, way back in 1969, but the same pattern repeats. So people who are looking at this and have been looking at the inverted yield curves, and have been looking at the collapse in trade indices, and have been looking at the Baltic dry goods shipments, and trucking orders, and all this kinds. All those things are down, and so in some cases dramatically down, and that all signals global slowdown in economic activity. And if there's less people buying and selling things, then there's less global activity, and there's less income being produced throughout the world economies, and that's what a recession is. So a lot of people are taking this cut as one of these kind of signals where the Fed was raising rates, and then decides to cut because they've gone too far. Now, it's hard to say you've gone too far when we're still only at 2.25% or 2.5%. But if we look at this long-term trend here, going back to the early 80s, you can see the peaks of this kind of form a trend line, and we're at the top of that trend line now, even though we're only at 2.5%. So so on top of that, on a very short-term basis, the markets were so-called expecting a 50-point cut rather than 25-point cut. So it's on that side, the Fed did not give the market what they wanted anyways, because they wanted more cuts, easier money, even easier money, and they disappointed there. So, and then on a third level, there's been a very dramatic fight between the presidency and the chairman of the Fed. And in this case, it's Trump and Powell, right? So back in the 70s, you had Nixon and I'm totally blanking on his name, but it was a similar kind of dynamic. The president was trying to bully the chairman of the Fed to do what he wanted in order to gin up, basically fake economic activity and make his chances for re-election better. So same kind of thing is happening here. And the when Powell first came into the chairman of the Fed, he was talking strong language. He was saying stuff like, I don't care what the market wants. I'm going to do what I think is right for the economy, all that kind of stuff. And that scared a lot of people, but it also gained the respect of a lot of people. And then, Trump's been on his Twitter rampages about, the Fed is being too tight and it's screwing up the economy and blah, blah, blah. And a lot of people are taking this rate cut as sort of a surrender by Powell to Trump's bullying. So, on pretty much every level of analysis, it's not good. So let's go back to the S&P chart. So this is just the 1 day, right? But where are we in the larger trend? So here's 3 months. So you can see that's a nice negative candle there. There we were kind of in a bit of a rising channel, and that's broken now. So that's always fun. Let's see if we can pull in the. Let's see. You can see how that's breaking right there, and we want to draw a channel. So that's done. And if we pull back even more, let's look at 6 months. That's an even uglier candle on the 6 month because it's totally breaking this toppy pattern. And you can kind of see the way this curves is sort of forming the first half of a downward facing arc, which isn't great as far as bulls go. And here's the 1 year. So you can see that into the end of 2018, things were looking bad. Got some recovery, and we had a little bit of downturn there, and we came back up. But we're not significantly above where we were a year ago, basically, because we had this kind of double test of what was it, 29.20, 29.30, something like that, and then finally broke through, and but it looks like that breakout is fading quite a bit. And then if we pull back even more, here's the 2-year chart. Pretty much the same story there. Let's look at a 5-year. So this, if we go back to here, the Fed has not been in a normal mode since let's call it April of 2008. So it's been 11 and a half years since we've seen so-called normal behavior from the Fed, and we're not getting it now. So I mean, when we look all the way back, on a max level chart here, this goes, well, it's a bit too far back. Let's see if we can. That's an old trend line I have there, which is now broken by that candle there. If we go all the way back to the 2008 crisis, we've been in this crazy, upswing in stock prices, which is just, I mean, by any measure, is just utterly ridiculous. And millions of articles have been published about how margins multiples have been expanded to ridiculous levels, and expected forward returns from these kind of valuation levels are historically very low, and all that stuff. So the net result is it's not looking good. Will this be the exact catalyst that'll start the next downturn? Don't know. That's something that's very transient, and you never know if this is the one thing that's going to set everything off or not. So I'm not going to say that this is the moment, but it could be, and you want to be prepared for that. So in a broader scope, it's important to, I think it's important anyway, to understand what it is that the Fed is trying to do. So, the Federal Reserve manipulating the price of money comes from a very Keynesian analysis of how the economy works. So the basic idea is that, the cheaper money is, the more people will borrow and invest in long-term projects. So like houses, expanding businesses, all that kind of stuff. So the lower the rate, all other things being equal, then the more borrowing takes place, the more money is created, the more asset activity occurs. And the problem with that, though, is that there is inflation, because the higher the quantity of money, given other things being equal, given the same quantity of goods and services, the price of those goods and services has to rise. So they're always kind of going back and forth between trying to gin up economic activity, but not too much so that inflation destroys people's livelihoods. And that's not even getting into Cantillon effects, where the people who receive the new money first are at a strategic advantage over the people that receive it last. And that's a whole deep dive that I don't really want to get into at the moment. But basically, when the Fed is cutting rates, they're saying to the market that the economic activity is weakening, and we're going to make money cheaper in order to boost some activity. And so when they're saying that now, when employment is at record highs, stock markets are at record highs, it's kind of like, what more do you want? So what could the Fed possibly be seeing that makes this look bad? And the kind of rationale there is that, well, if it looks bad for at these officially best of times, then it must be awful, because when those numbers start to recede, then there's nothing holding them up, and that is a scary thing for the markets. So that's why we are seeing reactions like this. So it's going to be an interesting time. I'm not personally invested in the market right now. I haven't been for quite a while, because I'm a cash flow kind of guy, so I'm not a fan of high prices and low returns. So if and when we see a correction, like a major correction, then I'll be a lot more interested. If we get another 2008, 2009, where we get down to 600, 650, then I'll definitely be a buyer, and I'll be picking up those dividend stocks. We got Verizon here. I've got AT&T on my watch. We've got what's another good dividend? There's a lot of real estate investment trusts that pay great. Those you have to be a little bit careful with. But yeah. So when I start seeing 6% come around, that's my signal to start looking. And some issues are starting to show that now, but not enough. So anyway, that's kind of the story for today in reaction to the Fed. So if you have any questions, hit me up on Steam, and we'll talk about it.